Hello and welcome. And South Africa's public finances have long been a story of drift, of rising debt, widening deficits, and stubbornly weak growth. But in recent months, something has shifted. The economy is entering a cyclical upswing. The Reserve Bank has formalized a lower 3% inflation target. South Africa has exited the Financial Action Task Force grey list. S&P has upgraded South Africa's sovereign outlook. Bond yields have fallen, and Treasury has held the line on fiscal consolidation in the medium-term budget policy statement. Now, in his State of the Nation address, President Ramaphosa reaffirming commitments to logistics reform, to energy expansion, fixing municipal governance. There's also been a renewed emphasis on delivery. Yet, I don't need to tell you the numbers remain tight. Debt is near 78% of GDP. Debt servicing costs are at 5% of GDP. Growth is improving, but it's not improving decisively. So when the Finance Minister Enoch Godongwana rises to deliver the 2026 budget speech, he's going to do so not in crisis, but certainly in an atmosphere, in a climate of constraint. And in this special budget speech edition of No Ordinary Wednesday, therefore, we are going to preview the minister's upcoming speech, but I want to do it through three lenses. One is fiscal arithmetic, secondly, structural reform, and thirdly, investor confidence. And for that, I'm joined by regular experts, Investec's chief economist, Annabel Bishop, along with Treasury economist, Tertia Jacobs. To both of you, a very warm welcome. So, Tertia, let's begin with the numbers if we can. At face value, as I've suggested, the fiscal picture appears to be marginally better than maybe all of us feared. Revenue running at around 71.2% of the annual target. That's slightly ahead of last year. The deficit so far standing at 243 billion rand, narrower than the 286 recorded at the same stage about a year ago. So if this pace persists, the full-year deficit could undershoot the revised medium-term budget policy statement projection. So is this, in your opinion, the beginning of stabilisation or maybe just a temporary reprieve? What's the assessment?
Jeremy, that's a very important question. So I would say that with the November MTBPS, it feels like we may have turned the corner. And there were several reasons for it. The first is, there was an overrun in revenue, which is helping. And then we have the windfall coming from the commodity side. And then very importantly, there is more expenditure control, for example, counting the ghost workers. And that is playing off in the context of lower nominal GDP growth because of inflation is undershooting and the GDP growth is still relatively low. But I think from Treasury's perspective and with the GNU, there is agreement that debt consolidation is of primary importance.
Annabel, South Africa's growth forecast then has been revised lower at 1.5% this year and then rising, as we've heard, gradually thereafter. So the economy may benefit cyclically from lower inflation and marginally stronger global demand. But structurally, we all know familiar conditions still persist. Is the growth now the binding constraint on fiscal consolidation? Again, where's your head on that?
So it's certainly one big constraint. And I think, if you actually have a look at where we came from, in the 2000s, we had really strong growth, lifting to 5%. You recall, Jeremy, for a number of years, really from 2005-6 onwards, which pushed through a huge amount of government revenue. So it's incredibly helpful. And I think it's also a constraint, certainly, for bond yields. I would say that, when we do get into a virtuous cycle, when we start to see the economic growth potential increase and strong economic growth coming through from the implementation of the structural changes, then I think we really are going to see, a almost organic, sustainable type of government finance environment, economic growth environment. That's absolutely key. But what we have seen instead, and certainly over the course of last year, has been that there's really been a strong sentiment uplift towards South Africa. There's obviously been strong foreign investment into our bond market, and we've actually seen yields come off by about 200 basis points. And the key here is that it lowers borrowing costs. So when you have obviously lower borrowing costs, we're above 10% for government bond yields, now we're close to 8%, that also helps sustainability of government finances, if you know what I'm saying. And that's absolutely absolutely key. Let's also not forget as well, we had the credit rating upgrade, further adding to sentiment from a bond perspective and overall from a South Africa perspective. So, and we of course remain on a positive outlook from S&P as well. I think there's many factors rather which has come through as a confluence to help support government finances. But, from a forward-looking perspective, we really need to start embedding a stronger fiscal environment. We need to still see fiscal consolidation. Let's not forget that it's only seen as sustainable for emerging markets if you have your debt to GDP ratio at 60% or below. So there's that risk that it starts to balloon out, and that's where these lower borrowing costs are so helpful at the moment.
Tertia, let me pick up on that phrase forward thinking if I can. Investors are going to look beyond the rhetoric of the speech to implications, which is critical. From a market perspective, are there 3 numbers that you think matter most in this budget?
I think the first one would be the debt consolidation. So we know that debt is still very elevated at 78% of GDP, and of interest is that the investors looked beyond the high debt level. They looked at the possible turnaround. So that is the first point. But we need to see an improvement in fiscal consolidation, because I suspect what's going to happen here is that it's more a sideways movement. We really need to see a meaningful decline in debt servicing cost as a percentage of GDP. And that is why Treasury is running a primary budget surplus. So that's your net non-interest expenditure minus your revenue. So the problem is that even though our bond yields have come down quite dramatically, there's still a gap with the nominal GDP growth. So from that perspective, it is difficult to stabilize your debt servicing costs. And that basically means either the economy has to grow faster, which is the first price, or your bond yields have to decline as we continue to feel the constructive sentiment.
I just also add to what Tertia's saying as well. For me, also a very key number as well is expenditure. And the reason why I bring this up is because there's an additional expenditure risk. And of course, if you remember at the MTBPS, it pushed through a whole lot of additional expenditure items, and that she actually ate up the revenue overrun. And of course, as well, talked about potential further tax increases. So that's where my worry comes from, that even though for the first 9 months of the fiscal year, we're actually finding ourselves in a situation where the budget deficit is lower than it would be for the figure estimated for the year, if that now carries on for the full 12 months, even though we're in that good space, they could just eat it up with additional expenditure items. And of course, the Malanga Commission and all the others as well are the type of items that actually go into it. So that's just one of the concerns I have in the environment. Yes, we've got really good figures. We could have a good budget, but there is that outside risk that we're sitting on.
So let's then talk about revenue composition, if we can. Commodity prices, Annabel, as we well know, particularly in platinum group metals, have provided a lot of support. SARS has been allocated, if I'm not mistaken, around 4 billion over 3 years to strengthen collections. That's a good thing. It's targeting an estimated 550 billion rand in undisputed tax debt. So how material do you think this revenue windfall could actually be?
So it is important because it's not just the gold price, obviously, that's seen this strong rally. Also, we see, of course, platinum group metals as well. And the nice thing about it is that because of the small volume and high price of precious metals, it doesn't actually get hit by the port delays, for example, if you do go through a bad situation with exports. And, even though we've seen container traffic increase, for the fourth quarter of last year, there's actually been a pullback. There's actually been a decline in traffic. It's a bit of a stop-start. So it's quite nice that you've got a low volume but very high value good, which has really become our largest export now. Gold and precious metals is now our largest export. So yes, it is a windfall for government finances. And typically what is often done with windfalls, and in fact, even in some countries, you see a higher tax to capture more of the windfall, government often ring fences and then uses it for some certain issues now, or certain areas. Now, for us, of course, we think it's just going to go back into the general pot. But typically it can actually be stored and used for savings. In other words, to counteract a situation where perhaps you get very high oil prices and a very strong impact on consumers, negative impact, and then you can actually use that windfall to try and reduce oil prices to help in future date. We don't think that's going to happen. And unfortunately, I think the days of government storing up nuts in the tree, for example, for the winter, when things go bad, are probably over at the moment. And I think it's probably just going to go back into the expenditure pot.
So, Tertia, apart from nuts in the general pot then and being used for savings, looking at the economy, how could or how should Treasury best use this windfall?
Yeah, there's many areas. I think the first one, is to try and reduce the debt burden. So we will be watching what they will do with bond supply. In November, they announced a reduction. Number two is, I think what the most salient decision would be is to increase your CapEx expenditure. We really need to increase our fixed investment ratio from about, as a percentage of GDP, from about 14% to 30%. That's the big focus. So if we can see more of a switch from current to CapEx spending, I think that would be the first prize.
All right, Annabel, the deficit now, it's widened in recent years to around 5% of GDP, debt edging up, as I said in the introduction, to around 78%. Is it fair to say then that fiscal slippage has become the default trend and that avoiding further deterioration, just avoiding the deterioration, is perhaps perceived now as a success, which can't be a good thing?
Well, it's a good thing if they achieve it. So, we obviously have had a lot of fiscal slippage. Again, we saw it in the past MTBPS as well. Even if, it's 0.1 to 0.2 compared to what was projected, still fiscal slippage. And of course, as a consequence, if we look at where we are sitting now, at the 5% deficit, as you said, well, again, sustainability for an emerging market country is 3% deficit or less. So this is, the risk that we really are playing with. And I do think, that many years of fiscal slippage has become a characteristic. It's become normalized behavior for South Africa. If there's additional expenditures we're talking about earlier, and of course we saw the lack of appetite last time around in the budget for that increases, we'll just push it through to higher borrowing. And for me, that's an area that really needs to be focused on as a priority. We're having the fiscal anchors come in, and we certainly think they're going to be a type of flexible fiscal anchor, which is going to help to ground and even reduce these types of expenditure pressures. But of course, the bottom line is we actually need to reduce, not even stabilize, but reduce our debt to GDP ratio. It's absolutely critical because given the elevation in our debt to GDP ratio to above 70% and now towards the 80% mark since COVID, there's little room for a further crisis and for further monies to be borrowed. And of course, when we stare down the line, you're increasingly seeing the impacts from climate change. And of course, countries around the world are seeing that impact come through as well, that it puts huge amount of pressure on government finances. So, we have got several years to start to reel this in. But if we continue to allow this fiscal slippage to go out, well, we know that the climate change effects get worse every year. And that is really where government is expected to step in to help citizens, to help the country, to repair and to fix. And that can be quite a large worry down the line. So I really think both globally and in South Africa, we need to see debt to GDP ratios reeled in. The IMF talks about it globally going over 100%, and it is certainly a fiscal stressor.
I would like to add here, and the important thing in South Africa is with the GNU, and that is what we saw this time last year, that there's commitment from the GNU that we must stabilize the debt. Right? So if there's an increase in expenditure, it must be countered by a tax increase. And that was where the whole debacle about the VAT increase played out. So the compromise at the end of the day was that expenditure was increased, but at a smaller amount because the tax increase that we ended up with was actually relatively smaller. But the budget deficit has to be protected because that is what drives your debt to GDP level.
Explain this to me, Tertia, as we move on. Both of you have outlined a lot of positives, yet we still remain below investment grade, rated BB by Moody's and S&P and BB minus by Fitch. S&P, I think, maintaining a positive outlook. What in this budget, in your opinion, could or would demonstrate something to strengthen the case for an upgrade within the next year or so?
That's important because when there's been a rating change, normally the rating agency has about 12 to 15 months before it then either upgrades or go back to the current rating. So I think the key focus points here remain the debt consolidation, because the rating upgrade that S&P gave us last year was to give recognition for the reform momentum that continues. We've been removed from the fat of grey listing, and the MTBPS showed commitment to fiscal consolidation. In other words, not to let the debt to GDP rate rise further. So I think very importantly is if government can stick to its current path, that's important. And then very importantly, and that is what Moody's also look at, is what happens to fixed investment. So when is that kicker in infrastructure investment going to translate into higher private sector fixed investment? And in the SONA, the president reiterated the importance of the private sector to drive this infrastructure fixed investment. So that is where we need to see an escalation in the PPPs, in logistics, and especially water, which is now crass proportions.
All right, folks, hold that thought. We will pick up this discussion in just a moment with a look at households and municipal finances. But first, a quick reminder to subscribe to this podcast. If you value smart, informed conversations like this one and you want to get regular insights directly from the experts shaping the thinking inside Investec, make sure you follow Investec Focus Radio SA on your podcast app or right here on YouTube. And that way you'll be notified every time a new episode drops. Now, let's get back to the discussion. Tertia, there is another issue which I think is maybe a little less visible, but maybe more immediate to South African households. Treasury has effectively relied on fiscal drag in recent years, offering no bracket creep relief to personal income taxpayers. Another 20 billion or so has been penciled into the baseline. Now, in an economy that is growing at barely 1.5%, the question is, can households absorb further stealth tax increases?
Jeremy, again, it's so important. And I think that relates to, when we talked about the VAT increases last year, what was it replaced with? And it was replaced with bracket creep. This is the easiest way for Treasury to raise money is when people get inflation-related increases, the tax brackets are not adjusted. So that's an easy 16 to 18 billion rand per year. So what we have seen is that over the past 2 years, when bracket creep was the tax, that reduced disposable income by about 52 billion rand. Now, in terms of the context of the GNU and Treasury's commitment to keep the budget deficit unchanged to when you increase your expenditure, Treasury has penciled in another 20 billion and 21 billion rand in the next 2 fiscal years. And that is why your earlier question about what is the best way to spend that windfall tax revenue is actually so important. So I think, as we said, if we can increase capex spending, we do think there will be some relief in reducing tax brackets. So I think that will be another channel where they can allocate some of the windfall to.
Tertia, let me just continue. In terms of progress around municipal level, we know that many municipalities in this country are on the verge of collapse. What do we need to look for there? What might emerge? What should emerge?
That's also very important because we know that economic activity takes place at the local level. And for example, Gauteng contributes about 35% to GDP. It's the manufacturing hub of South Africa. So on the one hand, we've got Operation Vulindlela that deals with the logistics, but the local authorities are also now on its watch list. So in terms of what the president announced in SONA is that there will be a white paper published in April, and that is where it's going to look at the structure of local authorities, because some of the local authorities are just too small and too ineffective. We know that the true problems are actually cadre deployment, that there's not enough capacity, right? And there's a lack of skills. So that also needs to be addressed. And I think a lot of that could perhaps manifest in the local election at the end of the year. But the president has said that there cannot be now intervention from the national and provincial governments into dysfunctional municipalities. Very importantly, also in the context of the water crisis, has been the move to start to ring fence trading revenue from municipalities. For example, when households pay for water and electricity, that money actually went into a pool which went into paying salaries. So there's now a big drive to ring fence it so that it can actually go into maintenance of infrastructure that's really been neglected. So I think we're watching this, but it's absolutely critical because that is also something that's holding back growth.
So let's move on to the fiscal framework and how exposed it is to renewed wage pressure, which is also a factor.
Yes, so you can see pressures coming in from every side for government finances. And, in past years, we actually have seen that big concern. Of course, we've obviously seen multi-year bargaining come through now. What is very interesting is that the new inflation target, the 3% target, is so well below where the bargaining has started historically, and even where bargaining starts now. And this, of course, is going to be the big kicker, the big issue. And also from a secondary perspective, not just for fiscal policy, but for monetary policy as well, getting inflation expectations down are key to keep South Africa's inflation rate embedded around the 3% mark. And particularly that really talks to then salary and wage increases. And of course, we recall decades ago when we actually had those rolling strike actions, which really decimated the economy. It can actually cause you to go into recession. It was so substantially significant. Now, we're not anticipating that to happen again. And of course, the multi-year wage bargaining agreements are specifically done to try and take a lot of the heat out the system. But I think there is a period of friction now, trying to force down this very substantial and elevated wage expectations in South Africa to obviously the new inflation target range. Look, we're in a very sweet spot. We've got a situation where low global oil prices, very substantial rand strength against the US dollar, mostly as a consequence of US dollar weakness, and of course very modest agricultural prices globally have all helped in getting inflation down very substantially in South Africa, along with weak demand. But, we expect that cycle to turn. We expect economic demand to strengthen quite substantially in South Africa, which could put some pressure on our inflation and in turn then on living costs and then feed through back into these wage bargaining agreements. So that's a very large component of the budget. It's a very large component of expenditure, and it will be closely watched. It will be something that the credit rating agencies also look at very, very closely as well, because, here you're actually, again, embedding something in the system, and it's actually something that needs to start to come off. Look, Tertia talked about removing ghost workers earlier, the rationalization, streamlining of the civil service. But I think, last year they also announced as well that there's a need to move off quite a lot of highly paid elder civil servants, early retirement, and bring in younger, lower cost civil servants because of wage progression. So I do think it's going to be a focus, but probably not as big a focus as it has been in previous years, given that there are so many other issues crowding in now as well.
So to both of you, a lot to absorb. And now I want to congratulate both of you. For the next 3 minutes, you've both been appointed special advisor to the Minister of Finance. So back to you, Annabel Bishop. What's the single most important signal that he has got to send if you had a few minutes in front of him? What would you say to him?
Look, I certainly think again, and for me, it comes back to the debt to GDP ratio. It's just so crucial for me because, what I really worry about is this huge rally we've seen in bond markets gets reversed. We're in a global risk-on phase, and there's huge appetite for risk assets around the world. There's huge appetite for South Africa's government debt. And of course, that cycle turns. We do see these cycles turn. So I think that with the winds of the precious metal rally and, of course, the strengthening that we could have in our government finances, I think government needs to actually look to reduce surpluses quite urgently and put a real cap on additional expenditure. We just cannot continue to have this because it just blows out the budget. So that would really be the point that I would make, to watch expenditure more critically and to try and actually start to reduce the debt to GDP ratio. It's not necessarily about stabilisation only.
What would you say?
Jeremy, so I'm going to go from the assumption that there is a commitment of debt consolidation. So I will use my opportunity to make big inroads into the professionalization of government, to improve the efficiency, the functioning, the delivery.
I was just going to say, from your lips but let's see how it goes. Let me finish by saying this. South Africa, as you've just heard, I don't think needs a dramatic budget. We certainly don't want that. But we do need, as both my guests have said, a credible budget. The arithmetic, as you've heard with all the data, is tight. The politics, obviously, it's South Africa, always delicate. And the margin for error this time around is very thin. But there are signs that the country may be moving from deterioration towards stabilisation. That's a good thing. Whether that shift, though, becomes durable is obviously going to depend less on promises and I think more on execution. And that's where we are going to leave it. Annabel Bishop and Tertia Jacobs, thank you very much indeed. A new episode of No Ordinary Wednesday drops every fortnight. To ensure that you don't miss a show, follow Investec Focus Radio SA wherever you get your podcasts. If you like the channel, please take a moment to rate it. It will help us reach more listeners. Until next time then, goodbye from me, Jeremy Maggs, and the entire Focus Radio team.